there has been a drift back maybe in the current geopolitical component where governments recognize that startups are key for bringing innovation from universities to commercialization towards the industrial capacity and productivity of the whole country.
Welcome to Brave. Learn from Southeast Asia's best tech leaders. Build the future, learn from our past, and stay human in between. No BS on success. I'm Jeremy Au, venture capitalist, Sierra founder, Harvard MBA, science fiction nerd, and dad of 2 daughters. Every week, we debate startup news, interview changemakers, answer listener questions, and share personal insights. Join our movement of over 40,000 members and get transcripts, resources, and community at www.bravesea.com. Stay well and stay brave.
Okay, so what are common challenges for investing in education tech? Education tech has 3 major issues. The first is the buyer is not the customer or consumer. So in other words, I think kids in education are the people who are often consuming. However, the buyer is the parent or the school or the government. And so these can be very different dynamics. So it's like a nonprofit, right? Is the beneficiary is a prisoner who wants to go back to the workforce, but the primary person who pays for this is the government, right? In terms of the cost of prison or rehabilitation and so forth. So there's a difference in that incentive structure versus the value, right? Versus if I was selling you a luxury handbag, that is very clear, right? You are very happy to have a luxury handbag and I will pay for it because I have the capital for it. So it's a much simpler purchase process, but education tech is one of those that tends to be there. The second problem that tends to be there is that obviously it's not necessarily very easily, it is not homogeneous. So what I mean by that is the Singapore education system is very different from the Indonesian education system, which is very different from the Vietnamese education system. And yes, I think obviously we want kids to learn math and English and so forth, but there are significant curriculum and legal definitions about what's available or what's not available. So for example, is a lot of education tech has to be supplementary or complementary to school. If in Singapore, for example, you can homeschool your kid, but you have to make sure that your kids pass Singapore local exams, right? For example. Now, and also if you think about it, your competitor or your incumbent is a local school, which is effectively free, right? For locals, because it's subsidized by everybody's taxpayer money, right? So I think it's a social contract that people have. So what I'm trying to say here is that when you have a tutoring agency, etc., you can't replace the school easily. But if you replace the school, then you need somebody to take care of the kid, etc. But if you take a giant step back, actually, you can imagine that startups and the latest technology devices can actually provide very fast or accelerated learning outcomes for kids. So to some extent, the classic school model of having 30 kids in a class versus having a super genius AI that is reading your kids' eyeballs while they answer questions on math on a screen, obviously is one-to-one algorithmic training versus a group situation probably. And I think you see in the US, a lot of historically, homeschooling was done for personal or religious purposes, but now you see that a lot of high performers are starting to work on homeschooling to use the latest technology because they believe they can get better outcomes for their kids who may want a more enriched or more accelerated curriculum. So I think that's number 2. And now, of course, the last problem that we have here is that I think that there is quite a lot of a passion subsidy for education tech. So obviously, there's a lot of people who are subsidizing it in the sense that people want to work on it because it's a worthwhile and problem. So it's a subsidy to the sector because everybody wants to help out and provide support. But from an investment returns perspective, actually, if there's an oversupply of talent or capital for a space, then there's less opportunity for you to find underpriced opportunities in a space. So in other words, some tougher problems that are less compelling or less purposeful may have less talent, and there may be more arbitrage opportunities or investment opportunities for upside potential from a VC perspective. So that's the 3 things. I think generation 1 of startups back in the 1970s, 1980s, 1990s, everybody would have told you that government support is very key for startups. So I think you have we talked about how ARC, which was the founder for venture capital, was actually a US government program. Obviously, we saw DARPA, the American Defense Agency and research side, do a lot of subsidies. So I think government grants were super key. I think everybody would have agreed on it. I think the last 2000s to 2020, where a lot of the internet was moving into software, I think that there was a reversion to the thinking where people started thinking that government grants are not supportive, or it needs to be a much more competitive, or government grants are not supportive. But I think there has been a drift back maybe in the current geopolitical component where governments recognize that startups are key for bringing innovation from universities to commercialization towards the industrial capacity and productivity of the whole country. So for example, if you look at the US, for example, Harvard, MIT, obviously they do a lot of research at a PhD level, and that they have a lot of support from the government funding. And then one of the things they have to do is they actually have a licensing and commercialization office where they are looking for startup founders to take their technology and negotiate agreements or licensing agreements to take their technology to market, right? And so both of these programs, you can think about it, are subsidized by a government. One is the basic science and research is being subsidized by a government. At another level, the universities are being subsidized through being classified as a nonprofit, so they don't pay taxes. They receive a lot of subsidiary support to support that as well. I think government grants will continue to not only be a feature for startup activity, but will continue to accelerate actually as a percentage as countries focus on that. So I'm going to go through the legal side. When we think about navigating a startup landscape, I think we need to think about three things. Is that first of all, there's obviously the founders and there's investors. But I think we need to be mindful of three major principles. I think the first major principle is that founders do have a duty and fiduciary duty as officers of the company to do what's best in the interest of the company. And investors who come in, obviously, to invest in it also have a shareholder responsibility to act in the best interest of the company. At the end of the day, a startup is still a company. They have to be thoughtful. They have good faith in the decision making. They should not misrepresent their company. Neither should they conduct illegal activities as an officer of the company. So as a company, the second thing, of course, is that we have to be aware that it's really about risk and reward sharing. So founders in the early days are taking on 100% of the risk. And then as a result, they get 100% of the reward when they first incorporate a company. But as investors come in, they put money in to capital, knowledge, time. And as a result, they will take on more risk as well for having more rewards as well. So I think startups have to find that balance where both sides are respected, but it's not overly leaned towards one end or the other end. So for example, if it's overly aligned towards investors, then for example, you may find that the startup founders are no longer incentivized or not interested in building a company any further because they don't have enough reward or skin in the game for them to keep going. Vice versa, obviously, there are founders who are acting in the best interest of the founders and not acting as good officers or directors of the company. And so they are not taking care of the shareholders. And that's actually a lot of the angst that's happening in Southeast Asia is because this is really the first generation of founders who have to deal and work with this set of parameters. Lastly, of course, is that startups are very young. Obviously, when a company is a public company that is very large with several $100 million of revenue, they can have all the bells and whistles in terms of shareholder agreements, board directors, checks and balances, etc. But there is way too much legal compliance for a company that has started, for example, this year. And when a company starts out, there needs to be that thoughtfulness about the company and having the right size of legal compliance and requirements for the right size of the companies. And in other words, not choking off their ability to grow and become a home run. And actually, that's really quite key because to some extent, there is an understanding that startups that are pushing for home run returns may actually have less legal obligations or less reporting obligations than they would for a same size company, for example, but is not aiming for home run outcomes because the investors are making a decision to say, we want our founders to be spending more time out of the business and pushing as hard as it is, and we'd rather give them as much risk, but also give them as much reward as possible so they are motivated economically to pursue this, but we don't need to use legal controls that have a high compliance and reporting requirement that will distract them from actually pursuing the big pot of gold at the end of the rainbow. So I'm going to walk you through some of the legal agreements, and obviously this is, I would say, a high level set of parameters across all of them that's available, but it's not meant to be exhaustive in terms of a very thorough and deep conversation. So the first agreement that I often talk about is what I call the founders agreement. And this is quite key because founders often have a very messy birth process or conception process for what the startup looks like. So what I mean by that is that founders are often meeting new founders, they're hiring new employees, they're attracting customers, but they are often doing this without a company. So there's no legal company, there's no legal agreement technically. So it may be two people working in a room and they're just saying, I want to work with you. And sometimes those teams break up and then a new founder comes in or a new employee comes in. So what often happens is that the founder's agreement is quite key. It's normally a piece of paper or Google document, but basically it's a documentation of the in principle or high level agreements between both parties or three parties about how the reward should be split, but also the roles and responsibilities. And again, it's not a legal agreement in the sense that there's a stamp or whatever it is, but it can be some kind of documentation that's there. And this is often consulted many times because there are often disputes that happen afterwards. So it's very common, for example, that when the startup begins to succeed, a lot of former founders may come out of the woodwork and say, hey, I played a role in these early days. I should receive a slice of the equity or upside. And so this agreement, one of the minimum requirements that it should really cover is two parts, is agreeing that if you leave the company within a certain period of time, you're not going to get anything. And that the longer you stay in a company, the more equity you get in the company. So these are like the biggest chunks, I would say, that's most common and most recurring as problems in terms of legal agreement. This, of course, will get drawn up into the next stage, which is when the company is incorporated. So, for example, some founder agreements, they may take 1 or 2 years or 3 years even before they incorporate the company. And one of the things that people have to think about is obviously what kind of company you're incorporating. So, for example, one of the big ones would be, where's your jurisdiction? Are you incorporating this in Delaware as a US company? Are you incorporating this in Singapore because you're in Singapore? Or maybe you're an Indian or Indonesian company. You may choose to incorporate in Indonesia, India directly. That being said, the jurisdiction that you have, obviously, as you can imagine, has big impacts. For example, many funds who are American funds that would not invest in a Singapore domiciled company, but they only invest in American domiciled companies. So it's very common, for example, to hear about Singaporean or Indian companies or Indonesian companies who are re-domiciling the US 2 or 3 years after setting up because they want to access American capital, right? And so maybe set up a holding company in the US as part of that process, which you can imagine is some work, but it could be justified for the right capital base, right? There are also the converse of that. There could be also different tax implications for that as well. So for example, if you were to set up a company in the Philippines, you are taxed based on your revenue and not taxed based on your kind of like profits, right? And so that's actually a big problem for a lot of Filipino startups that there's a current lobbying by the startup community for that to be redone. Because you can imagine that if you're a startup, let's just say, and year one, you're making $1 million revenue, but you're burning $2 million, so your net loss is $1 million, but you're paying tax on the $1 million of revenue, and let's just say you're paying 10%, then you have a $100,000 tax bill at the end of the year. So this would be a jurisdiction that would be considered startup unfriendly. And that's why you often see that many startups in Southeast Asia actually domicile themselves in Singapore. So Singapore is very much the Delaware for Southeast Asia and South Asia. So you imagine that in Pakistan, in Bangladesh, a lot of these companies will also domicile in Singapore because they are able to access the right lawyers who understand the jurisdiction, but also they can tap capital networks that are based in Singapore, comfortable Singapore as a jurisdiction, and they can work with accountants and so on and so forth.
Thank you for listening to Brave. If you enjoyed this episode, please share the podcast with your friends and colleagues. We would also appreciate you leaving a rating or review. Head over to www.bravesea.com for member content, resources, and community. Stay well and stay brave.